From the morning reading, stocks rally following pre-market pullback as stocks form bull flag and breakout setup patterns. PANW gaps, ADSK higher. 5 of 9 sectors moved higher on Tuesday. XLE, XLB, and XLV were the strongest sectors, while XLF was the weakest sector. Breadth strengthened as advancers led decliners 1.46 to 1 on the New York Stock Exchange. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:06 a.m. Central Time, and I'm recording this in preparation for the market day of November the 25th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. And indeed, we are slightly positive on all 4 of the broad market U.S. indices. The S&P futures at the time of this cut were up 3 points, or about 0.14%. Russell's up about 0.25%. NASDAQ is similar to the S&P, and the Dow is up about 0.1%. Crude oil down sharply, down 1.9%. Euro's down over 0.5%. Bonds are essentially scratch, and gold is essentially scratch. In terms of overseas action, kind of mixed directions. China's up 0.9%, Hong Kong's down 0.4%, Japan's down also about 0.4%. As a presage to our own markets, Germany's up sharply 1.5%, and the United Kingdom up about 1%. We have a full slate of macroeconomic reports for today. Some of the stuff being pushed forward because of the trade holiday tomorrow in the United States. But we have core durable goods, unemployment claims of the weekly variety, core PCE price index, durable goods orders month over month, personal spending month over month. We also have new home sales, and in addition to that, during market hours, revised University of Michigan consumer sentiment and University of Michigan inflation expectations. We had the regular Wednesday crude oil inventories, and then also the natural gas storage report. So full slate, but we'll probably see after the morning session and Europe closes that things will probably get relatively quiet as traders start to leave the desk and head out for the Thanksgiving holiday. Thursday will be closed. Friday technically will be open, though the markets will be very, very likely very thin and directionless and choppy. You'll probably have a slight bullish bias. Usually what happens on those partial trading days, so kind of keep that in mind. But in terms of being able to day trade on Friday, that would probably be a day you best would serve doing research or frankly just enjoying family and things like that. It can be a very, very poor trading performance day historically. Now, obviously, if new information comes into the market from somewhere, it won't be from a macroeconomic report or some sort of speech that's been scheduled, but if something geopolitical or something like that comes into the market, that could certainly create an opening for the markets to move. But absent that, it's likely to be very, very quiet. In terms of current volatility, relatively quiet yesterday. We had a morning inflection, and then that then drove up during the bulk of the day. No standard deviation moves were put in yesterday on any of the 4 indices. You see short-term VIX at a 14.5. Skew continues to remain elevated. IV percentile 17 on the S&P, 12 on the Russell, 14 on the NASDAQ, and 19 on the Dow. Relatively quiet all in all there, with the exception of this elevated skew. People are absolutely buying hedge protection, and that's what's giving us that skew. In terms of the regular daily report, Let's quickly go to our charts. One thing I did want to kind of point out about yesterday's action, notice these wicks on yesterday's action. So we definitely had this rollover weakness, but that was then met when it came into some key support areas by the bulls, and there's a significant reversal in the intraday pattern here. You see here in the S&P, we actually ended up with a green candle after being pretty sharply down on morning weakness. So that is bullish, and shows that the institutions were willing to come in at that area. So remember, we talked about coming down about halfway through this big body candle, and that being kind of the first important area of support, and that certainly seemed to become true yesterday. Now, as to where we go today, we've got a lot of macroeconomic reports, so that will probably be the stimulus that will take us. I mean, right now we're slightly up. Let me give me just a second here. Price actions is not anywhere significant enough to get excited up or down. Right now, it's going to be depending on these macroeconomic reports. It'll start coming out during the pre-market in about 20 minutes, and then on through into the cash market. In terms of seasonality, we would have an expectation for today to be bullish, Friday to be generally slightly bullish, Monday to be relatively weak, as all the traders come back. Usually that Monday is a little bit of a sell-off. In terms of the Russell yesterday, note that that catch-up pattern continues, and even though there was some morning weakness, it's less pronounced here, and a much larger green candle here on the Russell. So this one continues to be relatively stronger than the other indices in the last few days. Also, a similar reversal pattern on the NASDAQ. Not as strong, though, as the Russell. And then finally, the Dow, very similar to the S&P. In terms of VIX futures, still down here in what we would call the bull phase, below an 18. So nothing extraordinary in terms of the chart pattern or the level there on the current VIX futures to get us all that excited. And then let's take a look at bonds. Nothing there on bonds to be anything of a significant tell. So there you go with that. In terms of the daily report, we still remain in the phase 2, which is a bullish phase, a trend reversal. The diagonal breakout was what created this phase 2. IBD status remains confirmed uptrend. Accumulation distribution score on the S&P chart and the NASDAQ chart remain a C. We still have somewhat weak breadth here, though they have improved somewhat in recent trading sessions. GMI index dropped a notch to a 5 out of 6, but retains its buy signal and is still there since 1019. That author remains largely in cash, but has started to take some positions. Primary market condition remains neutral bear. We do have updates today from the stock charts decision point scoreboards, and you notice on the short term still mixed signals. On the intermediate term, all bullish, and the long term still mixed signals. So there were some updates in there, but nothing that really changes the overall opinion. And indeed, the consensus between these various mechanical signals on the portfolio investor posture is that we are still in transition, and yet to remains seen as to which direction this is going to break, whether we get new all-time highs or this rolls over and creates a bearish scenario. The bias would be bullish, and that bias is heavily influenced by this intermediate term, which is our primary trading time frame here at Falcon Global. And you notice that the intermediate term market posture is very bullish with an upslope sentiment. Indeed, when you put all that together, our position sizing opinions, those mechanical signals are certainly saying 100% position sizing at this point. That intermediate term market posture is very bullish, and you see all 4 indices are very bullish and had improving scores yesterday. Hedge warning status remains 0+. and this will likely remain a 0 plus until we get to all-time highs. It's normal, but with some elevated risk conditions, you're not likely to lose that plus until we break out and establish something out of this transition. Get those time frames between the short, the intermediate, and the long-term stacking in alignment, as opposed to going in sundry directions. In terms of specific metrics, in terms of warnings, the only things that get concerned about is the distribution day count on the S&P retains a 6, the NASDAQ dropped to a 5, but still both are high and in the warning status. Skew continues to be elevated up over 135, and that's a 12% probability of a 2 standard deviation move within the next 30 days. In terms of other warning areas, the only other thing is the intermarket risk aversion indicators continue to be warning us, with 3 out of the 5 signaling as risk off. In terms of special opinions, I'll let you read through this, but bottom line, there's no changes here from yesterday. It's acceptable and cautiously bullish, so all 3 strategies are a go. Depending on the aggressiveness of your underlying and the chart pattern, you might consider various levels of defensiveness, and I've got a number of suggestions here as to how you might establish that level of defensiveness. Remember, the market is still in that transition phase. This is not a clean, healthy bull. So make sure that when you initiate your positions and you manage your risk of your portfolio, that is a reflection of that you're engaged, and which would reflect a hedge risk level of 0 plus. You should be engaged, you should be cautiously bullish. At the same time, you should have some defensiveness to your construction of your position. In terms of sector market posture, sector specific, you see short, intermediate, and long term all generally in pretty good shape, with the exception of utilities, and this is very, very close actually to a crossover. So you could actually see, if we had a decent day on utilities, that this could turn positive. In terms of percent change, you see energy, big day yesterday, though last night crude oil was down, as we saw in the morning report. So that should be enough there. In terms of, if you find that this is helpful to your trading, we again acknowledge that receipt of your pleasure by your likes on YouTube, your subscriptions to the YouTube channel, which is free, and then also you're retweeting us to your Twitter followers, to your StockTwit followers, etc. You can send direct commentary to Falcon support at falconglobaltraders.com. In terms of special topics today, I think the one that I'll focus on is these daily price guides. You see the website here to get a lot more information about this. This is certainly a tremendous value at $25 a month for 8 key markets. Or if you're a day trader on the jumbo stocks, you can certainly go with also the $25 for a month to this 8 markets here, including Apple, Google, Amazon, and Netflix. To give you a feel for what one of those guides looks like, here's one here from last week for the commodity group, commodity futures group. But you see, this is just absolutely packed and stacked with the information that a day trader would need to understand where all the key support and resistance levels are to the particular market that you're drilling yourself down into. You can identify not just those key areas of support and resistance, but areas of confluence and clusters, as it were. Also overlap the value areas and the chop zones. These are all indicated here. Pivot ranges. All this is included and is delivered to your email box each morning before the market opens. So that is the daily price guides. So more information again at this website. Other offers currently. And then disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And as always, we'll see you back here on Monday morning for the Falcon Global Market Preview. There will be no recording for Thursday or Friday due to the trade holiday. Good trading and have a great holiday.